We are looking at question two of the free response portion of your practice exam. So we're supposing that the US government implements a fiscal policy that increases the budget surplus. Well, you should know right away this is going to be a contractionary fiscal policy. So the government is either going to cut taxes, which is going to increase the revenues, or increase the taxes, I should say, increase the taxes. I said that backwards. They're going to increase the taxes, which brings in more government revenue, which is going to increase the budget surplus, and or they're going to cut spending, which is going to also increase their surplus. So we want to draw a correctly labeled graph of the loanable funds market and show the effect of the increase in the budget surplus on the equilibrium real interest rate. Now, think about that. We're going to show the government uh, demanding less, fewer loanable funds because they're not borrowing as much, and also savings in the loanable funds market. I mean, not savings, the supply of loanable funds comes from savings. So if the budget surplus for the government increases, that's going to increase national savings. So when we look at the graph, uh, you could draw it either way, right? You could draw the demand curve shifting, and I should actually change this to solid and change this to, there you go. So it's not confusing. So we're actually shifting the demand curve to the left because the government is demanding fewer loanable funds because they're borrowing less, because they're collecting more in taxes and they're spending less in order to increase their budget surplus. Or you could draw the shift to the right in the supply of loanable funds. So the supply of loanable funds is going to increase because because when the government increases its budget surplus, that's going to increase national savings. Okay, so that's part A. Either either one of these graphs would be correct. Okay, part part B. Let's jump back over here. So the European, I'm right up here. The European Union is a major trading partner of the U.S. Given your answer in part A about the real interest rate, will the U.S. dollar appreciate or depreciate against the euro? Explain. Okay, well, the short answer is the dollar is going to depreciate against the euro, and you could explain it by saying that the demand for U.S. financial assets are going to decrease because of the lower real interest rate. So financial assets are purchased by investors who want to get a high return on their investment. So when the returns in the U.S. start to get lower, they're going to look outside the U.S. for higher returns. So that's going to mean that uh, the supply of dollars in the foreign exchange market is going to increase because investors are going, say, to the eurozone and buying euros with dollars so they can invest in the eurozone. And you could also say that the demand for dollars in the foreign exchange market is going to a decrease. You could get this shift right here. Either a shift, either the supply curve to the right or the demand curve to the left is going to lower the value of the dollar against the euro. You can think of it as it'll take fewer euros to buy a dollar with these two shifts. Okay, and then the explanations are over here. They so both of these would be good. Okay. Part C. Part C. Suppose the Federal Reserve, which is the central bank of the United States, decides to offset the change in the value of the dollar identified in Part B. Would the Federal Reserve buy or sell the euro? Would the Federal Reserve buy or sell the dollar? So what the Federal Reserve wants to do is they want to bring the value of the dollar back up, so that they want the dollar to appreciate against the euro. So you don't have to draw the graphs, but I have, because it really helps. Okay, so let's go back over here and let's look at it. So the short answer is the Fed would buy dollars and sell a euro. So if we look at the market for dollars right here, if they buy dollars, it's going to pull the dollars out of the foreign exchange market. So the supply of dollars is going to shift to the left, which is going to raise the value of the dollar against the euro. And then if we look at it from the perspective of euros, see, I've got euros here on the horizontal axis, and I've got the euros in the denominator up here. So if they're going to sell euros, when they sell euros, that's going to put euros into the foreign exchange market, because they're selling them to the market. So that's going to shift the supply of euros to the right, which pushes down the value of the euro against the dollar. And so if the euro is becoming less valuable compared to the dollar, it means that the dollar has to be becoming more valuable against the euro. So when the euro depreciates, the dollar has to be appreciating. Okay, so this is why the answer is what it is. Okay. Part D. We're asking, suppose the Federal Reserve wants to counteract the real interest rate change identified in Part A. What open market operation would the Federal Reserve use? Well, jumping back over here, the Fed wants to raise interest rates, so they're going to sell bonds they're going to sell the bonds, and that's going to pull money out of the money supply, which shifts the money supply curve to the left. Now, you don't have to draw these graphs or for your answer, because it's not asking you to, but it just helps you to see why the answer is the answer. Now, when the money supply shrinks and banks have less money to loan out, and depositors have less money to deposit into banks, then the supply of loanable funds in the loanable funds market is going to shift to the left. which is going to push the real interest rate back up, which is what we wanted to do to offset. Let's just jump back over here to make sure what happened in part. Okay, what happened in part A, which was the real interest rate uh, decreased. Okay, so we're trying to reverse that trend. So the Fed is going to sell bonds in order to decrease the money supply, in order to lower the supply or decrease the supply of loanable funds in the loanable funds market, which pushes the real interest rate back up. Excuse me. Okay, that's it for question 2.